good afternoon. Thanks for tuning in. My name is Patrick Worley. I'm the founder and the CEO of the Worley Group. Proud to be here with you today. Proud to have a fabulous tax bill to be able to share with you. You know, I was reading several publications recently and attending some conferences online, and many very, very important tax experts in our country have called this bill probably the most significant piece of tax legislation, not in recent times, but in United States history. It does such a great job of addressing a lot of issues that, frankly, have needed to be addressed for years, and it's all in this one bill. So we're excited. Let's get started.
In the Big Beautiful Bill, what are the major tax changes for most clients?
So most of our clients, of course, are 60s and 70s. They're retired, although we still have people that maybe their retirement didn't work out. We wish we had met them sooner. They wish we had met them sooner, and they're still working. So the major issues, and we'll talk about them kind of one by one, are going to really help lower income people. Maybe not necessarily our client, but still an important part of our economy. Again, promises that were made on the campaign trail and promises that we see being kept. So again, we have a $12,500 worth of tips that people can receive, up to $25,000 for service workers. Auto loan deduction, haven't seen that forever. I'm old, and so I remember when not only was the interest on your car loan deductible, but your credit card interest was actually tax deductible. That's amazing. That's before your time, I'm sure. The SALT cap, state and local taxes, is now up to $40,000. So if you have a large home in maybe a nice area of Houston or Dallas or Austin, you can now deduct up to $40,000 of your annual property tax each year. By the way, there's some workarounds for that. If you have more expensive property, we could certainly talk with you about that. The standard deduction is permanently in place, as well as the child tax credit. So again, a little something for everyone. One of the things that I try to help people understand whenever we're meeting is that most of what they've heard about the bill, or they've heard about maybe the political angle of the bill, most of that is not true. It's not in the bill. The bill does address a lot of issues for everyone, both small and great, as we would say.
How does the Big Beautiful Bill affect retirement accounts like IRAs and HSAs?
So great question. HSAs are magic. I mean, they are magical. Even an IRA, you're going to pay the tax. You're just kicking the can down the road. You're deferring the tax, and we'll talk more about that in a moment. But HSAs are magical, and it increases now the amount of money that you can put into a health savings account. Coolest thing in the world. You put the money in, you get the deducted off of your income for that year. And when you take the money out, you don't have to pay taxes on it. Again, it has to be used for certain purposes because it's a health savings account. But it does increase that a little. IRAs are basically intact. There is, however, a new $6,000. That's a lot of money for seniors to offset taxable retirement income. Makes their life a little easier. And again, that's the element I spoke of a moment ago. Sorry to repeat myself, that it does different things for different people, but the overall package, again, is going to benefit everyone.
Are there any changes to estate or gift tax rules?
So that's a lot of our clients are very wealthy, and we're excited about that. I know they are too. So this is a question that comes up a lot. The answer is no, nothing changed, and here's why. There's such a small percentage of people, unfortunately, that have wealth that could trigger a federal estate tax, not an inheritance tax, that's different, but a federal estate tax. And so they don't get a lot of attention. They're wealthy, but there's not very many of them. And so it didn't really change any of that. And let me kind of put a plug in here. If you're working with an accounting firm, or you're working with a maritime firm, or somebody that's really sitting down and talking to you about design, planning, we're not just preparing your tax returns, we're talking about what might happen in the future. Long-term care, is that a possibility? Yes, it is. Again, these kinds of taxes on larger estates, is that a possibility? Yes, it is. Remember, we have this administration for 3.5 more years. That's it. I would hope that people would be able to see the performance here and take that into account in the next election, but obviously you never know. So if you have a plan, keep working on it. If you don't have one and your estate's kind of hanging over a little bit and you're expecting good growth 8, 9, 10 years down the road, you might want to sit down and think about what it looks like to give $5,000 or $5 million more to your children or your church rather than the United States government. So again, at this point, nothing really changed. You need to continue to do what you're doing or maybe start a new program.
With the new Big Beautiful Bill, does audit risk increase for high net worth clients?
So actually, so no, and here's why. Let's talk about that for just a second, because we prepare an awful lot of tax returns every year for both regular people that are retired and for business owners. And the big question, of course, that comes up all the time is, am I going to be audited? Is this a problem? I had a lady the other day. She's a very successful real estate lady, and she has not been deducting her mileage. And I asked her why. She's a new client of ours. Why haven't you been deducting your mileage? She said, well, it's a red flag. I said, honey, it's not a red flag. It's the law. Did you drive your car last year around all over town showing property? Well, yes. Well, those miles are tax deductible for you, you know? So anyways, audit risk, by the way, we defend audits. One of the things that we do for clients of the Worley Group, if you get into a little trouble with the IRS, we're there to help you and save you, and we have an excellent track record of that. Audit risks are a function of possible success. In other words, if I have a revenue officer and I have a chance to go audit Patrick Worley, who's an enrolled agent with the United States Treasury Department, knows a little bit about the tax law, I'm probably not going to make much money. I'm going to spend 20, maybe 30 hours of my time, probably won't get much. Now, if I go audit a mid-sized corporation maybe that is lying and saying that their employees are not employees, but rather independent contractors, which they're not, by the way, by definition, that revenue officer can make some money on that deal. Maybe 400, 500,000, who knows, plus fines and penalties. So it's just because somebody is higher net worth doesn't automatically mean they're a bigger risk. The question is how much money would the IRS expect to make by investing their time, sowing their time into that particular harvest? So again, best way to do it is just always be honest. If you have an issue, talk about it with a tax professional, and let's make sure that you don't even ever get contacted. Audits are great. We can defend them. Better not to have one.
Which investment sectors may benefit most with the Big Beautiful Bill?
Great question, because there's a lot of companies that are about to catch on fire in a good way. Not a bad way, a good way. Manufacturing is going to be one of those because we have hundreds of billions, now maybe even trillions of dollars of manufacturing coming back to America first, United States of America. Very, very exciting. The high dollar paying jobs too. Then oil and gas, just yesterday. I'm not sure when you're going to be watching this, but just yesterday, we signed our deal with EU, and they've agreed to buy 750, this is with a B, billion dollars of oil and gas assets. Does two things. One, it weans them off of purchasing oil from Russia and Iran for obvious humanistic reasons. But in addition to that, of course, it creates an amazing amount of power and control as the United States becomes now a net exporter of oil and gas. So we're very excited about that. Oil and gas, a wonderful industry. Tech, obviously, we want to be the tech leader of the world. We're trying to shore up our electrical supplies and generation to be able to cope with this. They say now that we're opening a data center. We used to do a large mega data center maybe once a month. We're now opening one a day. And we expect that to get to as many as 5 or 6 a day. So that's a great industry. And again, that this is kind of a downhill conversation because once you understand how the tax law has reformed the economy, you want to start investing in that economy. You want to start taking advantage. It's funny because it's all tax law driven, kind of the tail wagging the dog for a change. So again, clean energy, by the way, is on the way down. It didn't perform well. It wasn't reliable. It was government funded. Unfortunately, I won't go there. And so most of those incentives are gone and should be gone. And now we're doing things that make sense, that pay bills and create income and jobs. That's great.
Can we only use bonus depreciation for business assets?
So great question. And the answer is yes. But let's talk for just a second about what is depreciation. Depreciation is not good. In every other country of the world, if you invest $100,000 in a piece of equipment, you get to deduct $100,000. Why? Because you invested $100,000 in a piece of equipment that's going to help you to do your trade or business, make a profit, and pay taxes on that profit. In the United States, until this law, if you bought a $100,000 piece of equipment, you got $10,000 to deduct. Well, wait a minute. And I've had people sit across my desk and say, wait a minute, I paid $100,000 for that piece of equipment. Why do I only get $10,000? Well, unfortunately, your ability to deduct that is severely limited by the Internal Revenue Service, actually by Congress, who passes the law that the Internal Revenue Service obeys. Well, suddenly, you have somebody who comes along that's a business person and can do mathematics and says, well, wait a minute. If you buy a piece of equipment that you need for your trade or business that's cost $100,000, you now get to deduct that $100,000 because that's what you paid for the equipment. Amazing. So yes, bonus depreciation is back. It's exciting. It's a huge, huge tailwind for people that have been needing to buy equipment, wanting to buy equipment, but weren't able to make the deduction. So it's back. It is unfortunately only business assets, but that's the arena that we're in here. By the way, it's effective here in 2025. Not sure when you're watching this video. By the way, you may want to share this video if you have some business friends or people that own businesses, friends or neighbors, people that you don't like, whomever. This might be a good video to be able to share with them. There's another form of depreciation acceleration. I call it common sense eration, and that's called Section 179. Section 179, that limit on how much equipment you can buy and deduct has also been increased now to 2.5 million. So it's a pretty exciting time. By the way, quick story. A lot of people will call me and say, hey, I want my income taxes to go down, so I'm going to buy some rental property. Not a good idea. Here's the problem. If you pay $600,000 for a rental property and it's sitting on a $200,000 piece of land, you only get to deduct the structure. You only get to deduct what they built on the land. So now you're down to $400,000, and you only get 1/27th of that amount of money, 1/27th. So that's not that. I don't think that's kind of what you're going to want to do. Now, if you bought a piece of equipment, a yacht, for instance, just an idea, and you paid $600,000 for it, you get the whole $600,000 the next day. Now, again, there's issues there that we need to talk about, you need to understand, but come on, that's a pretty good incentive. So bonus depreciation is back at least through 2029, maybe even 2030, depending on the circumstances, and we're excited about that in a business setting. By the way, some of the noises you may be hearing, we're in our beautiful new motorsports office up here in Magnolia, Texas. And they're still working on it. These are brand new buildings, and so if you hear an occasional noise or drilling or something, that's somebody getting something done. And again, we're excited to be here, and we're thankful that we have this new office.
Are capital gains, dividend tax rates, or the 20% pass-through deductions changed in the Big Beautiful Bill?
So the answer is good news, no. We still have them. Now, previous administrations that wanted to continue their presidency had promised to do away with long-term capital gains treatment. But let's take a moment. What is that, Patrick? Thank you for asking. In certain assets, if you own them for a year and a day, it has to be the Bible, the IRS says, more than 1 year. If you own it for a year and a day, your taxes, when you sell it and you make money, you make a profit, can be zero. Pretty cool. I like that one. 15%, or it's capped at 20%. As opposed to that tax being as high as 37% if it ends up being ordinary income. Well, all the promises to take that away from people never got fulfilled. So now we still have long-term capital gains treatment, and yes, we still have the 20% pass-through. What's that? Again, that's a special break for small and mid-sized businesses that puts more money in their pocket so they can hire more people, create more jobs, buy more inventory, expand their businesses, things like that. All that was left alone. It should have been left alone. That was one of the few really beneficial parts of the tax law prior to BBB coming along. So they're all exactly the same. They're alive and well.
Do Roth conversions still make sense under this bill?
Absolutely. It's funny because I'll have people that'll argue with me. They'll bring a knife in to argument, and I just take out my gun and say, you never bring a knife to a gunfight. I can trump, little joke there, I can trump their argument because my Roth, I pay zero tax. They go, well, yes, but our taxes are going to be lower. Yeah, but mine are zero. Well, we think lower taxes are going to stay the same. Wonderful. Mine are zero. So yes, I still think that we should continue. If you're not on a regular annual, how do you eat an elephant, one bite at a time Roth program, then come in and talk to us about that. If you are, then stay on the program. A lot of people say, well, I guess I don't have to do Roth conversions anymore. Oh, no. We don't know who the next president's going to be. We have this gentleman for 3.5 more years. Hopefully, again, people will recognize, hey, we like income. We like being number one. We like putting our country first. We like that, but that may not happen. So I would absolutely continue. Again, whether taxes go up or down, zero is still a pretty good tax rate. Just a thought.
Should clients consider a bit more diversity within their portfolio, maybe even an out-of-market approach?
Yes, and here's why. We love stocks and bonds, and we're great at that. There's no issue there. But a lot of people have kind of forgotten, maybe again, real estate purchases and having some of the advantage of owning real property. That's a completely separate issue. A lot of people have too much money, in my opinion, in mutual funds. And mutual funds maybe aren't paying them the kind of dividends that they could receive. So we're also big on guaranteed income. I think a lot of people have kind of forsaken that, and that's a mistake. That's a mistake. In any common sense retirement approach, you need to have some guaranteed income. You need to have some money that's going to come in that front door if the husband dies or becomes incapacitated. Long-term care, again, mixed with guaranteed income. Do you want to put all your money in that? No, of course not. Should that be a portion of your portfolio that you should consider with your tax advisor and with your financial advisor? Absolutely yes. So again, a little bit more diversity these days, I think, will help us with volatility. And here's the other thing. When people come in that have a diversified portfolio, they're comfortable. They're in Italy or wherever they are enjoying their retirement. They're not huddled in their house watching, television trying to see if they made any money that day. So guaranteed income not only can be helpful, it can change your attitude on being able to spend some money and enjoy retirement in these last few years that we have left on the earth.
What are the next steps for strategic planning surrounding my retirement and my investments?
If you're our client, and first of all, if you are, thank you. Thank you for your business. Thank you for your trust in our experience and the good job that we've done all these years. When you're telephoned by our staff, please come in and see us. Years ago, many years ago, we used to see people minimum annually. And then we got to thinking, man, there's too much going on to let 365 days go by between now and when we see Bob again. Well, we dropped it to 180 days. We've recently dropped it to 90 days, and believe me, there's so much that can happen in 90 days. We need to see you. We need to find out what's happening. I had a lady that came in the other day, has a very grave illness. I didn't know she had that. And when she came in and sat down, we could talk about it and what the effects and financial and taxes and deductibility of long-term care, things like that. So come in and see us. That's kind of the next step. If you're not a client of ours yet, we'd like you to become a client of ours. We'd like to sit down maybe for lunch or dinner some afternoon and talk about what that might look like again for you. Roth conversion math, we've talked a little bit about that. Everybody's different. Everybody has a different goal. Charitable strategies. You may love the Lord. You may love your church, and you may want some more money to go to them and less money to go to the Internal Revenue Service. I don't know. But those are some things we could start talking about. Now that we have a tax bill, now we can get started. Now we've got something that we can refer to. We have a foundation upon which we can build a great retire well plan as well as a good tax plan, and then update that, and then update that, and then keep updating it. Keep changing the oil, as we say, to make sure that the motor's running well. So again, come in and see us. If you haven't seen us for a while, if you've been traveling, let's sit down and talk and just make sure that all the T's are crossed and all the I's are dotted under this new law. So thank you. Thank you very much for your time. I know we're all busy. We're all probably too busy. That's a separate video that we'll talk about someday. Thanks for watching. If you've gotten this far, by the way, and you find that some of this information is useful, then go down and subscribe. There's a lot more information, a lot more content we'd like to provide. Somebody said the other day, well, I guess you're bored answering my questions. And I said, no, your questions are important to you. They're important to us. That's the way we've run our company all these years, and it's helped us to be able to grow. But still, being able to watch a video in your PJs at 11 o'clock at night when you will not be talking to me on the phone is a good thing. So again, subscribe, and we'll make sure that we're putting more content like this for you.